Hi everyone, welcome back to this session. So in today's session, we'll understand Greeks. So for today's session, we'll understand what are Greeks. Greeks are in general, Greeks are used a lot in options and option trading. So you will see a lot of traders and risk managers, talking about Greeks and stuff like that. And even it's, very, very important for from a interviewers from an interview points perspective. So if you are going for any quant finance interview, it is for sure that they'll ask you certain questions on Greeks. So very important topic. So let's understand, before going, okay, so let's understand what is Greeks, okay? See, Greeks are risk measures which are used in options to understand the sensitivity of the option price with various factors. So, what are Greeks? Greeks are risk measures. So, Greeks are nothing but risk measures which are used in options to assess or understand the sensitivity of the option price to various factors. Okay. So, what does this mean? See, in the previous lecture, we did spoke about, okay, what is options, what is call option, what is put option. Now, there are certain factors which definitely affect the price of the option, right? So, so let's say this is your option contract or this is your option, you know. If you want to understand, or if you want to understand what are the risk measures in this option, that's where you'll use Greeks. So to understand the risk in the world in the options world, we'll use the concept of Greeks. Greeks is nothing but it helps you understand how option prices, or it helps you understand the sensitivity of the option price with various factors. So this is the option contract. So what we are trying to say is, okay, what all factor affects this option, we'll try to understand those factors. Okay, so this is nothing but, by the definition, it's nothing but it's used to assess the sensitivity of the option price with various factors. So we'll understand what are various factors, okay? Basically, or if I want to give you a simple example, you know, so certain people might be sensitive to certain things, right? So if you see this person A, so if you see this person A is sensitive to certain factors, okay, to certain things. So what we're trying to understand is how much this factor affects this, how much this factor affect this, so and so on. So similarly, even in the world of options or in the world of derivatives, let's understand which all factors affect options. So coming to the Greeks. Okay, so there are, in general, when we talk about Greeks, there are five different Greeks. So in general, there are five different Greeks, okay, that are nothing but delta, gamma, rho, theta, and vega. So these are five different Greeks which are used to understand what is the risk in your options. Okay. So what is delta? So let's cover each of them. Okay. So let's say what is delta. Delta is nothing but it tells you the sensitivity of your option price with respect to the underlying asset. So what is delta? It tells you the sensitivity of the option price with respect to the underlying asset. So, I just want to first cover the definitions of each of the Greeks, if you see, and then we'll go into detail into each of them. So just bear for a few minutes till the time I cover the definition, and then we'll go into super deep. So if you see what is delta, it is nothing but it tells you it tells you the sensitivity option price with respect to the underlying asset. Okay, so this is very important. This is nothing but delta. Then the second is gamma. Gamma is nothing but the sensitivity of option price with respect to delta. And I totally understand if you're not able to follow, because this is, I'm just writing for the sake of writing. We'll actually go into deep. So always we'll check the sensitivity of the option price always. Okay, but the parameter, if you see here, the parameter was underlying asset, right? So when the parameter is underlying asset, we'll say it as delta. And when the underlying is delta, we'll say that as gamma. Okay, but we'll always check the sensitivity of the option price, that will remain constant. Similarly, theta is what? Sensitivity of option price with respect to time. Then we have rho, which is nothing but sensitivity of option price with respect to the interest rate. Or you can also say risk-free rate. And so, and the last piece is theta, sorry, rho or vega. So delta, gamma, theta, rho, and vega. Okay. So vega is nothing but again sensitivity of option price with respect to the implied volatility. Okay, so if you see here, so option price with respect to time is called theta. Option sensitivity of option price with respect to risk-free rate is called rho, and sensitivity of option price with respect to implied volatility is called vega. Okay, so how I used to remember was, because it starts from t. So we are sensitizing option price, or we are finding the sensitivity of option price with respect to time. So T for theta, T for time. Similarly, R for rho and R for risk-free rate. Similarly, V for vega and V for volatility. So this is a simple trick to remember how sensitivity of option price we are sensitizing with respect to different parameters. So let's go into detail into each of them. So let's deeply understand delta first. But are you guys able to understand what we are trying to do? So what is Greeks? Greeks is nothing but it tells or it helps us to understand the sensitivity of option price with respect to various factors. Now, as I said, various factor can be underlying asset, can be risk-free rate, can be volatility, can be time, right? So basically, if you see, this is how the definition looks, but let's understand in detail. And if you guys have any doubt, please feel free to stop me. Okay, so what is delta, right? So as I said, delta is nothing but it tells the sensitivity of option price with respect to the underlying asset. Or it can be also written as rate of change of delta, can be also written as rate of change of the option price relative to the change in underlying asset. So mathematically, delta is represented by this. Delta is equal to dou V by dou S. Okay. Where V is nothing but price of the option and S is nothing but your underlying asset. So dV represents what? Change in option price. And dou S represents what? Change in underlying asset or change in underlying asset price. So is this clear to everyone? Okay, thank you. So now, so this is what basically delta means. Like, how much your option price is changing with respect to your change in underlying. Now, the thing is, delta can be either positive or negative, depending on the type of options and the position of option. So what does positive delta means or what does negative delta means? Let's first understand that before going into this. Let's first understand what this positive and negative delta means. So, so what is positive delta? See, as I said, delta is nothing but it represents what? Change in option price with respect to change in underlying. So when I say delta is positive, right? What does this mean? So positive delta basically means that the option value will increase when the underlying stock prices increase and it will decrease when the stock price decrease. Okay. So what this positive delta means? It means that the option value will increase when the stock price increases. Similarly, option value will decrease when the stock price decreases. So basically, what we are trying to say is it shows a positive relationship. Okay, it shows a positive relationship. So a quick question by Amanda is how to pronounce this notation, right? How to pronounce this notation? So this is called delta. It is actually called delta only. In the industry also, this notation is called delta. And also, you might be thinking, why have I written like this? Why have I written like this? Dou V by dou S and not ds by dv. You might have this question, right? So what happens is this is so this is called ODE, which is ordinary differential equation, and this is partial differential equation. So this we will actually cover when we talk about the modeling piece. Okay. So don't worry here, but just remember why we write dou v by. Okay. So okay, let me cover that concept also. So what happens in ODE? Okay. So let's say when let's say the option price. Okay. If this was only affected by just one variable, then you will use the concept of ordinary differential equation. But let's say if this option price is affected by multiple parameters, right? Which we saw, right? Volatility is some parameter that it will get affected. Interest rate is some parameter. The price of underlying asset is one parameter which will affect, and there are other parameters also, right? So when multiple parameters affect your function. So let's say this is your y, okay, and this one is x1, x2, and so on. So when you have something like this, right? So let's say there are multiple parameters that is affecting this. That's when, and when you take derivative of this, that's when we say we take partial derivative. Okay, then we take partial derivative. So, okay, so just to quickly summarize, when only one factor is affecting, we will say that as ordinary differential equation. We will write as dv by ds. Okay, but when let's say multiple factors are affecting, then we will do partial differential equation, and we write this as dou v by dou s. And guys, this will cover in the modeling piece. Don't worry, we'll cover this everything in the modeling piece. This is just for you to understand, okay? So how we say this is delta is equal to dou v by dou s, which is nothing but how your price changes with change in how your option price changes with change in underlying. So positive delta, what this means is that once if you're so positive delta means what it means is that value will increase if the stock price increases. Similarly, option value or option price will decrease when the stock value decreases. So this is what you mean by positive delta. So basically it has you can say it has a positive relationship. But what is negative delta? So let's understand what is. Okay, so let's understand what is negative delta. Okay, so negative delta is nothing but, it's just the reverse. So what happens is when the option value increases, so negative delta basically means that the option value will increase when the underlying will decrease. And similarly, the option price will decrease when the underlying increases. Okay, so it basically has a negative relationship. So what does option negative delta means? It basically means that option price will increase when the price of underlying asset decreases. Similarly, option price will decrease when the price of underlying asset increases. So basically, we can say that it has a negative relationship. So we can say that option price has a negative relationship with the underlying asset. Is this clear or not? Up till now, is this clear or not? Please, if you guys can use the chat section up till now, is it clear? Okay, perfect. So now let's see how does the delta of call option and put options look like. And then I'll also give you an example just for you to understand delta in a much better way. So let's understand how delta values for call option and put option looks like. Okay. So basically, okay, sorry, my bad. Okay, so basically for a call option, delta will be 0 to 1. Okay. And for a put option, delta will be 0 to -1. So for a call option, you see delta to be 0 to 1. And for a put option, you see delta to be 0 to -1. But like what it means, what does this mean? Let me explain actually, because that will make you understand it much better. But let me also, further simplify, and then I'll explain what it means. So for a long call option, the delta is nothing, it's between 0 to 1. Okay, it's between 0 to 1. Can you tell for short call what will be the range? See, always remember, derivative is a zero sum game, right? So if someone is in a long position, we'll just take negative. So 0 to -1 is for short call. Okay. Similarly, for long put option, we have 0 to -1. And similarly, for short put option, we have 0 to 1. But let me make you understand what does all this means. Let's say if I say that delta is zero point 0.5, what does that mean? Let me explain you that first. So so this is, just to remember that for a call option, the long call option, the delta is 0 to 1. For a short call, it's 0 to -1. For long put, it's 0 to -1. And for short put, it's 0 to 1. If you just remember one, just remember for long position and then take negative. So you'll get it for short position. Remember in this way if you want to remember. Okay. So now let's see what does it actually means. Okay. So let's take an example of call versus put. So delta for call option. Okay. So what it means is, let's say we are given that delta for a call option is 0.5. So what it actually means is that for every, so what it means is for every $1 increase in the underlying asset, the okay, for every $1 increase in the underlying asset, the option price will, so the option price, what will it increase or decrease? The option price will increase by how much? 0.5. Okay, so this is what it means. See, basically what I'm trying to say is why, okay, first of all, quick question. Why is it increase? Because call option has a positive relationship, right? Call option has a positive. First, see, if you see what we studied, first, first we studied that call has a positive relationship. That is, call is between 0 to 1. Okay. And when we say it has a positive delta, right? So positive delta, what happens when the stock price increases, the option price will also increase. Okay. So this is what we studied up till now. So basically, so when I say that the delta of a call option is zero point 0.5, it basically means that for every $1 increase in your underlying asset, the option price will actually increase by zero point 0.5. So let's see with the help of example. So let's say delta is what? Change in option price with respect to change in your underlying asset, right? Now, how much is your change in underlying asset? It's 1, right? And change in option price is what we'll try to find out, right? And delta is what? It is zero point 0.5, right? So what is change in option price? It's zero point 0.5, right? Dollar 0.5. So that is what I'm trying to say. See, when your this increases, when your stock underlying increases by $1, your your delta, or sorry, your option, sorry, when your underlying increases by $1, the underlying asset will also increase by $1. Okay, sorry, by zero point 0.5, which is nothing but delta. So let's see. For similarly, so let's say similarly, I say that delta for put is zero point 0.5, negative zero point 0.5. What does this mean? So this basically means that, what does this mean, right? So this basically means that for every $1, okay? So what does this mean? So basically it means that for every $1 increase in your underlying asset, your option price will decrease. So your option price will decrease, okay? By what quantity? By $0.5. Okay. So one is increase, the other one will decrease. And that's why we say, it's a negative delta. Why we say negative delta? Because it shows a negative relationship. And so basically, if the underlying asset will increase by $1, your option price will decrease by zero point 0.5. Okay. Or to put it in better words, okay. So let's say, let me put it in this word, sorry. Okay. So how I can say is a delta of negative zero point 0.5 basically means that for every $1 decrease in the underlying asset, for every $1 decrease in the underlying asset, the option price, the put option price will actually increase by how much quantity? $0.5. So this is nothing but it shows why. So if you see decrease, increase, so it shows a it shows a inverse relationship. That's why we have negative work. And this number basically tells you how much the value of your option price will get affected. And this actually tells you the direction of it. So I hope, is this clear to everyone? Up till now, is this clear to everyone with these two examples? When I say that delta for call option is zero point 0.5, whereas for put option it's zero point 0.5. Is this clear to everyone? So basically, just to revisit the concept again, when I say the delta for call option is zero point 0.5, it basically means that for every $1 increase in your underlying asset, the option price will also increase by zero point 0.5. And similarly, for every $1 decrease in your underlying asset, the option price will increase by zero point 0.5. So this is what it means by uh, call option of zero point 0.5 and put option of negative zero point 0.5. Is this concept clear to everyone? Okay, so a question asks this: how these values are calculated? And that's a very good question. Like how delta is calculated. So we have, okay. So to first, even to come up to delta, we first need to have option price, right? We first need to calculate option price. So for calculating option price, we have different mathematical models like Black-Scholes. So we have Black-Scholes, binomial tree, and then we have Monte Carlo methods. So these are different methods which we use to first calculate the option price. Then once we calculate the option price, then we calculate delta. Okay, is that clear to everyone? Okay, so I hope that answers your question. Yes, so we'll definitely discuss all these methods because this is where the mathematical modeling starts. If you see Black-Scholes model, binomial tree model, Monte Carlo methods, these are quantitative modeling practices that are also used by the industry folks. So we'll definitely discuss, and that's where I was saying the last 2 months of the bootcamp we'll do all the modeling piece. So definitely this is also included in this bootcamp. So we'll see this, but in the end, but as of now, I just want to focus on what it means by delta. Is this clear to everyone? Okay, perfect. So now let's understand what is the meaning of delta based on the moneyness of the option. Okay, so what is the meaning of delta based on moneyness of the option? And also, a simple way to remember this whole thing is, a simple way to remember this thing is by using this timeline. So this is 0, this is 1, this is negative 1. Okay. So 0 to 1 is for what? It's for long call and short put. And similarly here it will be. So this is nothing but long put and short call. So if you see, I have just, summarized this into this diagram. So basically, delta is between 0 to 1. It basically means either it's a long call option or a short put option. Similarly, when I say delta is negative, it either represents long put or short call. So this is the simple way, to remember it. Let's see for, okay. So, okay, guys, can you tell me for call option, what was the delta? For call option, what was the delta? Yeah, that's correct. It's between 0 to 1, right? So for a call option, the delta is what? 0 to 1, right? So in here it's we see 0.5. Okay, so now let's break further, based on the moneyness. We discussed the concept of moneyness in previous class. What is it? That there are three things, right? We saw in the money, at the money, out of the money, right? We saw these three concepts in our previous class. So if the delta is between 0 to zero point 0.5, we will say that the call option is in the money. Okay. If the delta is at zero point 0.5, we'll say it's at the money. And if the delta is between 0 0.5 to 1, we will say that as out of the money. So what we can say is for in the money, the range of delta is what? 0 to zero point 0.5. When we say point at the money, it's point. When we say it's delta is 0 0.5, that means the option is call option is at the money. And when we say that the delta is between 0 0.5 to 1, we can say that the option is out of the money. Oh, my bad. Oh, I just told the reverse way. Oops. Okay, sorry, my bad. My bad. Okay, sorry. So when it's okay, sorry, that is my fault. My bad. So okay. So what we can say is okay. So let me summarize it again. Okay, based on based on how we see it. So let's say if the delta is between 0 to zero point 0.5, we say that as out of the money. Okay. If it's 0 0.5, we'll say at the money. And if it's between zero point 0.5 to 1, we'll say that as in the money. So here you see in the money, here you see at the money, and here you see out of the money. Okay. So what does this actually means, and how will we remember this, right? So see, just remember this graph, you know. So okay. So this is a S-shaped graph. So if we see here, if you see this part, it is out of the money. Okay. If you see this part, this is at the money. And if you see this part, okay, this is where it goes from out of the money, sorry, at the money to in the money. Okay. Is this so this range? So if you see at this point is nothing but your point 0.5. Okay. Okay, it's better to paste a graph for you guys. Let me paste a graph for you all. Yeah, I understand. Let me give certain example for all of you to understand better. Just give me 1 second. Let me paste this graph for you first. Just give me 1 second, guys. Okay, just give me 1 second. It's not getting pasted. But yeah, let me make it again then. So so what I mean by this is, see, okay, so what happens is at here, so we see from here 0 to 0.5, we see out of the money. At zero point 0.5, we see at the money, and between this range from zero point 0.5 to 1. Okay, let's say the range is what? Range is 1. Okay, so the range here is 1. So we see 0 to zero point 0.5, you see out of the money. At the money is nothing but zero point 0.5, and zero point 0.5 to 1 is nothing but in the money. But let's understand, I understand giving an example would be better. But okay, but before that, so let's understand this in greater detail. Can you all tell me why is when I say delta is zero point 0.2, what does this mean? Can you all tell me? Can you all use the comment section to tell me when delta is zero point 0.2, what does this basically means? That, see, it basically means that it basically means that for every $1 change in your underlying asset, the option price will increase by how much quantity? Zero point 0.2, right? So to your question, right, so see, what happened was, in general, when traders communicate with each other, right? When traders communicate with each other, they define this delta. They define this they in a way that, if they just want to say, okay, whether the option is in the money, out of the money, at the money, they can also refer to as using delta, and that's like very common practice. So when they say that, okay, the delta is between, let's say delta is 0.75, that actually signifies that that your option contract is in the money. If it's zero point 0.5, option contract is at the money, and if the delta is 0 to 0.5, so it is out of the money. It's, you can say that it's kind of a standard practice, which traders and risk managers use to define the moneyness, to define the moneyness. Is it clear to everyone? So in other way, how I can say is, what is delta? Okay, let me, make it more simpler. So delta is the probability of the option contract being in the money at expiry. Okay. So it generally, so okay, what is delta? Delta is the probability of the option contract being in the money. Okay. This is very important. That being in the money at expiry. Okay. So when I say that, delta is zero point 0.2, it basically means that there is 20% chance of the option contract being in the money. Okay. So if you see, so you can always think in this way, when the range of delta is 0.5 to 1, it basically means that the chances of the chances of this option contract being in the money is what, between 50% to 100%. And it is, of course, right? I mean, when you if you see this range, I mean, if delta is 1, it basically, what it means, it means that the probability that the option contract will be in the money, the option contract will be in the money is what, 100%. And we also know that delta of in the money is what, between 0.5 to 1, right? So wherever you see here, whatever probability you see, let's say zero point 0.7, so this is nothing but 70% probability of your option contract being in the money. And when the probability is low, let's say zero point 0.2, right? Here, what's the probability? 20% of probability that the option contract is in the money. So when the probability is less, very less, it is of course that your your option contract is what, out of the money. See, if you have not seen the in the money, at the money, the previous video in which I explained in the money, at the money, and out of the money, I highly recommend it, because it's nothing but in the money. Basically, you receive the money, right? Out of the money, uh, at the money is no profit, no loss, and out of the money you have to pay the money. So I hope this becomes clear. So just to summarize it again. So if you see, for a call option, we see this range, right? For a call option, we see in the money is what, 0.5 to 1. At the money is what, 0. Sorry, yeah, 0.5 is at the money, and out of the money is what, 0.5. Now similarly, if I just want to plot for a put option, if I want to plot for a put option, how can I do that? It's very simple. Okay, so if I want to plot a very similar diagram for put option, so let me do that. So it's nothing but a mirror image. This will be for a put option. It will be nothing but a mirror image, and it actually starts from 0. Okay, so it will be something like this. Okay, so this is nothing but put option. So your y-axis is nothing but your delta. Okay, so your y-axis is nothing but your delta, and this is nothing but your stock price. Sorry, this is nothing but your range. Okay, so here you see 0, if you see here and here. So here delta, okay. Okay, so if I have done in this way, right? Okay, so let me do one thing. So here delta will be 0 to -1. Here delta is 0 to +1. Okay. So in this range, if you see, this is for what? Call option. And this range is nothing but for put option. Okay. So just so initially I plotted in x-axis. Let's put in y-axis. Okay. So now, so if you see from 0 to 1, right? This is 0 to 1, and this is 0 to -1 delta. So if you see, we are going from 0 to +1, right? And similarly here you see we are going from 0 to -1, right? So what we can say is for similarly, if you see, what we can say for put option. Okay, similarly what we can say for delta for put option is, we'll again divide what, in the money, at the money, and out of the money. So for in the money, your delta is nothing but negative zero point -0.5 to -1. At the money is nothing but negative zero point -0.5, and out of the money is nothing but 0 to negative zero point -0.5. So overall, you see that your delta of your put option is between 0 to -1, is what we covered, right? So what I'm essentially saying is, so we see 0 to -1. So, and this is your -5. So so if you see this range, this is nothing but you're out of the money. If you see zero point 0.5, this is your at the money. And if you see this range, this is your in the money. Is this clear to everyone? Sheikh mentioned that we cannot generalize that 0 to 1 is for for call option because depending on our position. See, whenever we say call and put, we always assume that we are in a long position unless stated. So so that thing is correct. I agree. I agree to your statement. You know that when I we cannot generalize that the call has 0 to 1 and put has 0 to -1. Okay, we cannot generalize. But to be honest, when we say that when we communicate it, we always mean in a long position. Okay, because as we saw that in a short position for put it will become 0 to 1, and similarly for call it will become 0 to -1. But whenever we communicate, we always communicate in a long position way, and that's why we say that the delta for a call option is 0 to 1 and for a put option is 0 to -1. But have you ever thought, why for put it's negative? Can you tell? We say that the delta is negative. Why is delta negative here? Can you all tell me? Okay, see, the thing is, why delta is negative? See, what is delta? Change in option price with respect to changing underlying asset, right? We know this for the fact that when the stock price increases, what is what is the effect on a put option? If you remember the option class, if you remember the option class, right? The price of put option will decrease, right? If your stock, so when do you buy a put option? You buy a put option when you expect the option price to increase, when you expect the option price to decrease, right? That's when you will buy this put option, right? If you think in a way, when do you buy a call option? Or so call option you buy when you expect the stock price to increase, right? So let's take this put option condition. So in put option, when the price is increasing, this is for us. So if you see the price is increasing, it is for sure that the put option price will what decrease. So that's why we see a negative relationship. And that's why if you see delta is what? Negative, which is what? 0 to -1. Okay, is this clear to everyone? Okay, okay. So let me check if I'm missing any concept. Give me just 1 second. Okay, yeah. Okay, yeah, correct. Okay, so let's see what is the impact of time to maturity on delta. And this is very important, guys. Impact of time to maturity on delta. Okay. So you see what happens. See, there can be only two situations, that we have short time to maturity, that let's say, do I mean by short time to maturity? That 3 months from now the contract is about to expire, and we are standing here just few days before. This is what it means by short time to maturity. And the second is what? Long time to maturity. Let's say the option contract will expire 6 months from now, and we are standing here. So this is basically, we have long term for it to get mature, right? So let's see, understand how does it impacts, right? Short term to maturity and long terms to maturity. So let's say let's take this example. Okay. So let's say if you are buying out of the money option, okay, if you are buying out of the money option, right, you need time for the stock to move up to the stock to the strike price. In other words, there is a much higher probability of the underlying asset finishing in the money for long time to expiration, right? So if you see, so we are in this stage, right? We have out of the money, at the money, and in the money. This is for, let's say, call option, right? So let's say we are standing here. Let's say as of now we are standing here. So okay, let's say we are standing here. So let's say if we have more time, it is for sure that when we have more time, the stock price will fluctuate, and eventually we will move from out of the money to at the money, and to in the money, right? Is this right or not? So basically, your stock has more time to move to the strike price. So when I say this, what it means? So if you are here out of the money, let's say you have 6 months from now, and your stock is out of the money, right? It is for sure that the stock price can eventually move to at the money and in the money. So there is much higher chance, right? Much higher chance of what? Of delta being in the money, of your option being in the money, of your option expiring in the money, right? Is this clear to everyone? Okay. So okay, and similarly, so basically we say that when it has a higher chance or higher probability of expiring in the money, then can we say that it has a higher delta? Can we say this? So basically, for long term maturity, we always have higher delta, okay? And for short term maturity, we have what? Lower delta. Okay. Why is that the case? See, let's say you are here. 3 months from now, your contract is expiring, and you are just standing 2 days before. Okay, you are standing 2 days before. You are standing here. Okay. So in 2 days, you also know that the stock price won't move that much, right? In 2 days, let's say you are you know let's say on the scale of delta, you are on the money. Okay, you are at this point on the money. So in 2 days, the stock fluctuation will be really less, right? The stock fluctuation will be really what? Less. And that's why there's very low probability that your option will expire in the money. So that's why we say that, because it has a lower probability. That's why we say that the delta is small for short-term maturity. Is this clear to everyone? Why for long term we see a higher probability, and why for short term we see a lower probability? Similarly, okay, so a quick question by Gopi is again depends between the difference between in the money and out of the money, right? So let's say, yeah, that definitely depends. But in general, this is how you need to think. I'm just see there can be multiple case scenarios, okay? There can be multiple case scenarios. So, but in general, this is how you have to think. Okay. So, so moving on, let's see, how does delta, okay, let's see impact of delta on impact on volatility. So we saw how delta gets affected by maturity. Let's see how delta gets affected by volatility. Okay. Now tell me one thing. When volatility, okay, let's see one thing. Uh, okay. Let's take two conditions. High volatility and low volatility. Okay. So let's take first condition. When we see high volatility, okay, tell me one thing. You see on the money, at the money, in the money. Okay. We have 0, 0.5, 1. See, when it's let's say OTM, okay, when it's on the money, right? Tell me one thing. When volatility increases, when volatility of the stock increases, what will happen? It has higher, you know, it will, of course, when you have high volatility, it will definitely go at a higher speed, right? So when you have higher volatility, it will definitely go at a higher speed, right? Your stock will basically fluctuate in a higher speed. So what happens? So basically, you have a higher chance when you have a high volatility. If you are out of the money, you actually have a very high chance that your stock goes into the money. So higher probability of your stock of your option expiring in the money, right? So that's why we say for a higher volatility, you always see delta is high. Okay. Let's see for a low volatility scenario. See what happens here. See, something is here. Let's say your delta is, let's say 1, or let's say delta is 0. Okay. So, when you have low volatility, this won't move the stock won't move at a very high pace. So when you have a lower volatility, stock fluctuation is low, right? Stock fluctuation is low. So when the stock fluctuation is low, so it has a lower probability expiring in the money. So it has a lower probability, what it means, it has a lower delta. So basically to summarize, so basically to summarize, high volatility has high probability to expire in the money, and that's why you see high delta. Similarly, lower, if let's say if the volatility of the underlying stock is low, so low probability of expiring in the money, and that's why low delta. Is it clear to everyone? Okay. So let me summarize delta again. So let me summarize delta again. So first, what does delta measures? Delta measures the change in option price with respect to change in underlying asset. First concept. Okay. Then delta is positive for call option. And when I say call, I mean long call. And delta is negative for put option. Okay. Similarly, for again, let's decide long call, it's what? 0 to 1. Short call, it's just take negative of it, 0 to negative 1. Long put, 0 to negative 1. Short put, 0 to 1. Then delta is also affected by what? Time to maturity and volatility, right? So how it gets affected by time to maturity? If you see you have high, let's say if you have more time, more is the chances of expiring in the money. So that's why you have high delta. And when you have less time, so less time for the stock to less time for the option contract to expire in the money. So that's why you have a low delta. Similarly, for volatility, if you have high volatility or low volatility, right? High volatility means your stock will fluctuate a lot. So there's more chances of your stock becoming in the money, and that's why you have a high delta. And for low volatility, you have low delta. Is this summary clear to everyone? Okay. So let me pause the recording here and let me restart the another recording.